So our topic for today would be adjusting entries. Adjusting entries are entries made at the end of every accounting period to update some of the ledger balances in order to prepare fairly valued financial statements. These are entries made to avoid over or understatement of balances, specifically those of assets, liabilities, income, and expenses. There are 7 types of adjusting entries, which are the following: accrued expenses and accrued income, which are the accruals; the prepaid expenses and the unearned income, which are the deferrals; depreciation, doubtful accounts, and merchandise inventory, which is only made under the periodic inventory system. Accrued income are basically income which you have already earned but not yet received, usually through the passage of time. The most common example would be interest. The pro forma entry for this adjustment would be to simply debit a receivable and a credit to income. Accrued expenses are those that have been incurred but not yet paid. This may also occur through passage of time. Interest can also fall under accrued expenses. Another example would be utilities, such as water or electricity expenses, which are typically expenses paid at the end of the month after incurring them. The pro forma entry would be simply to debit an expense for the amount incurred and a credit to payable since you have an outstanding liability. Prepaid expenses are expenses that have been paid for but not yet incurred. Simply put, these are advance payments. There are 2 ways of accounting for adjustments relating to prepaid expenses, namely the asset method and the expense method. Under the asset method, the original entry recorded involved a debit to an asset, in this case to prepaid rent, and a credit to cash. Notice that no expense has been recognized. However, at the end of the period, the asset would be used up, which is reflected by the recognition of an expense. An easier way to look at this is to think that the adjusting entry's purpose is to remove by crediting the amount of assets which has already been used up. On the other hand, the expense method involves the recognition of an expense in the original entry. However, a lot of times, the actual expense incurred is less than the recognized expense. Thus, the adjusting entry must reduce the amount of expense which was originally recognized. The easiest way to compute for the amounts under the 2 methods is to use a timeline as shown here. For example, you paid 60,000 rent on month 0 for 6 months. So that would mean you would have to pay 10,000 pesos of rent for every month. Under the asset method, you would have recognized a prepaid rent of 60,000. Under the expense method, you would have recorded a rent expense of 60,000. To get the amount of adjustment under each method, first mark the adjusting date. Here, it would fall on the 2nd month as shown. The left portion would represent the used or the expense portion, while the right portion would represent the asset. Thus, the total amount to the left of the adjusting point would be the amount of adjustment under the asset method, while those on the right would be the total adjustment under the expense method. Thus, in this case, the adjustment under the asset method would require debit to expense of 20,000 and a credit to prepaid rent of 20,000, while the adjustment for expense method would require a debit to prepaid rent of 40,000 and a credit to expense of 40,000. The next adjusting entry is for unearned income. This means that you have already received payment for income not yet earned. Again, there are 2 methods, the liability and the income method. Similar to the discussion in prepaid expenses, the adjusting entry would depend on the initial recognition or the original entry. Under the liability method, you recognize a liability which is shown in the account of unearned income and must therefore recognize income in the adjustment here. On the other hand, income was already recognized in the original entry under the income method, and therefore a liability of unearned income must be recognized in the adjustment at year end. This would be done by debiting income and crediting unearned income. Again, we could easily solve for the adjustment amounts using a timeline. Using the same example as earlier, assume that you received 60,000 pesos advance payment from a client on month 0. Again, we mark the date of adjustment on the second month. The amount to the left of the point of adjustment would be the earned income, which is the adjustment amount under the liability method. The amount to the right would be the liability and would amount to the adjustment for the income method. In this case, the adjustment for the liability method would require a debit to unearned income for 20,000 and a credit to income for 20,000, while the adjustment for the income method would require a debit to income for 40,000 pesos and a credit to unearned income for 40,000 pesos. The next adjusting entry would be depreciation, which is defined as the allocation of cost of an asset to expense over its useful life. The amount is simply an estimate rather than a factual measurement. The amount of depreciation for the year is computed using the straight line method. The formula for depreciation is given by the total cost of asset less the scrap value or the residual value at the end of its useful life, amounting to a depreciable amount, which is divided by the estimated useful life to get the total depreciation for the year. If the asset was purchased mid-year, you have to multiply the amount by the fractional years when it was used. So for example, if you only used it for 9 months, you have to multiply it by 9/12. The pro forma entry for the adjustment would be a debit to depreciation expense and a credit to accumulated depreciation. Another adjusting entry would be the doubtful accounts. The doubtful accounts represent the portion of accounts receivable which are estimated to be uncollectible. Typically, the percentage of accounts receivable method is used. Under this method, 3 scenarios are created, namely increase by a certain percentage, increase to a certain percentage, and aging of AR. Using a T account to analyze, multiplying the rate given by the ending balance of account receivable for the period under an increased by scenario would result to X, which is the required adjustment for the period. Thus, simply debit bad debts expense and credit allowance for bad debts for the same amount. Under an increased to scenario, multiplying the rate by the ending balance of the accounts receivable would give you the target ending balance for the allowance for bad debts for the period. Thus, to get the amount of adjustment for the period, you have to deduct the beginning balance from the amount computed. Again, the pro forma entry would still be a debit to bad debts expense and a credit to allowance for bad debts. Similar to the increased to scenario, the aging of accounts receivable method computes for the target ending balance of the allowance for account for the period. You do this by multiplying the amounts of accounts receivable by the percentage uncollectible and getting the total of all the amounts. The beginning balance of allowance is again deducted from the amount computed to get the amount of adjustment for the period. Again, the same pro forma entry is recorded. A debit to bad debts expense and a credit to allowance for bad debts. The last adjusting entry would be for the merchandise inventory. However, this adjusting entry is only made under the periodic inventory. This is because under the periodic inventory, no merchandise inventory account is maintained. All purchases are debited to the purchases account. The pro forma entry would be a debit to merchandise inventory end and a credit to income summary. Since the entry is made to recognize the merchandise on hand at year-end, a debit must be recorded so that it could be presented in the statement of financial position. Analyzing the formula for cost of sales, we have here purchases plus merchandise beginning less merchandise end is equal to cost of sales. We see that the effective merchandise inventory end would be a decrease to cost of sales, and in turn, that would increase your income. And that is the reason why we credit it to income summary.